Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire. McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement. Northwestern Ohio's resource for a common sense approach to planning for our financial futures is Chris McIntire, president and founder of McIntire Retirement Services. Chris, welcome back in.
Hey, Peter, it's good to be with everybody there today. And for those of you that are watching us on the podcast here, I got my OBX t-shirt on. Wife and I spent a little bit of time down here recently to social distance and get a little break. So kind of nice to be casual here on recording day.
Yeah, well, it's definitely a good area to sort of get away from it all, right, Chris? And there's been a lot to get away from. I mean, the election is over, but I think there's still some things sort of undecided, and the market certainly can't decide which way it wants to head. I think volatility is probably going to continue.
You're correct, Peter. And I think for most of us out here, we're ready to get a lot of the politics behind us, get on with some medical breakthroughs with the COVID piece, get life back to normal is probably going to be everyone's goal here in 2021. I know it is for us. I'd like to be able to tell the wife when I come home from the day at the office that I haven't been to in almost a year, essentially, since March, basically, and say, hey, let's go down the road and grab something, a bite to eat, and not have to worry about catching anything in the process other than the common cold, I guess.
Yeah, well, Chris, I still think that unfortunately we're a ways away from that, it seems like. The news is sort of one step forward, two steps back at some points in time. But I know that we have to continue on, regardless of what we hear in the news. And sometimes that's more of a distraction than helpful. But regardless of that, we have got to plan for ourselves and our own financial stability moving forward into the future. And one of those aspects, we've been talking about it for several of the past week's episodes, is planning for taxes and what taxes will look like, not just for last year. As we round the corner toward the end of the year, a lot of people are looking back at this year and trying to maybe make some moves to save money, but more importantly, how to save as much money and keep as much of our money moving into years into the future. And I know that you offer a lot of insight and guidance on that for your clients. And I do want to remind you, ladies and gentlemen, if you've got questions, if you'd like to plan strategically and proactively, Chris McIntire is your resource. Pick up the phone, give a call, 800-868-1194, 800-868-1194, either an in-person consultation, they are conducting those, or a virtual review, or even just starting with a 10 to 15 minute phone call to answer a couple questions to see if there's something that you can do proactively to keep more of your money. 800-868-1194, 800-868-1194. But Chris, I think that more and more people are realizing that some proactive tax management was almost as important, or will be as important, as the investment management has been up until this point.
Yeah, in full disclosure, Peter, I'm kind of a tax geek, and I enjoy the tax planning piece of retirement strategies as much as I do the investment piece here. So geek notice here, put everybody on alert, right?
Right. Yeah, but I mean, again, this is important stuff, Chris, and being strategic, being efficient, keeping as much of our money is oftentimes as effective as shooting for higher returns, but with far less risk associated with it.
Yes, Peter, would totally agree with that. And, as we're working our way into retirement, a lot of folks listening to the show today maybe have 90 to 95% of their money in an IRA or a 401k type account, where when they make those withdrawals, they're going to pay tax at ordinary income tax rates, which are just like your wages, ordinary income tax rate. So, when at age 72 now, the government mandates you must take distributions from those IRA accounts, those 401k accounts. And then the other side to that is, if you pass away and you haven't spent all of your money, you have to distribute those, or your estate or the beneficiaries have to distribute that money to themselves within a 10-year time frame. So, legislatively, a lot of things change here: income tax rates, RMD rates, what happens when the IRA owner passes away and the kids become the beneficiaries of it.
So a lot to consider there, Chris. And just to recap, we've been really talking about some of those strategies as it pertains to Roth accounts. The way the American public has been taught to save sets us up for our income to be just as taxable as our wages, even in retirement, with the tax deferral and the 401ks and the IRAs, as you just alluded to. Income in retirement will be 100% taxable from those accounts. We've been talking about some proactive moves to maybe reduce or lessen or eliminate some of those retirement taxes with Roth accounts and tax-free accounts that are available to us. And the advantages of the Roth IRA in particular are that growth is tax-free, that income is tax-free, that inheritance is tax-free, and there are several other additional benefits in the accessibility and flexibility of those accounts. And today, I think we wanted to take a little deeper dive and get into some of the specific strategies to get more money over to those tax-free accounts, correct?
Certainly, Peter. And, we have also often talked over the years of, when it comes to Roth IRAs, you folks listening, you're going to hear the word conversions and contributions. So Peter and I will try to differentiate between the two. So a contribution to a Roth IRA simply says that, if you're under the age of 50, you can only contribute $6,000 a year to a Roth IRA. Okay. If you were going to convert money from an IRA to a Roth IRA, you can convert any amount. There is no income threshold on conversions, but there are income thresholds on the ability to convert to a Roth IRA. And I'll say, in full disclosure, my wife and I cannot contribute to a Roth IRA. So we put the money into a traditional IRA type of plan that we have for a small business, a SEP IRA, and then we can convert it to a Roth. So, there are loopholes or backdoor ways, you could say, to get money into these accounts. But for most individuals listening to the show today, if you want to open a Roth IRA and start putting away money that'll be income tax free in retirement, you can only contribute $5,000 or $6,000 if you're under the age of 50, $7,000 if you're over the age of 50. They give you that catch up.
Yeah, just to make things a little bit more complex, there's actually age-banded differentiators there, where if you're a certain age, you got a certain amount. But if we say, Chris, that a paycheck, that earning money is money in your hand, and that saving it for retirement is putting it in your pocket, the government limits how much new money we can put in our pocket in our IRA accounts each year. It's only that $6,000 or $7,000, depending on if you're under or over the age of 50. But they do not limit how much we can move from one pocket to the other. Now, taxes will be due as we make that conversion, as we move from the tax-deferred pocket to the tax-free pocket. We have to pay, and that's the downside. But once it's there, it's growing tax-free. And again, there are certain limits and limitations, not just in the amount that we can contribute, but in how much we can earn and still contribute. And so that's why we've got these specific strategies for those who might be income eliminated or hit those limitations, or those who are not, how to get as much as possible into those tax-free accounts. And we'll go through those today. But again, ladies and gentlemen, if you want any help in identifying what strategy is right for you, or knowing with a little bit more certainty what that tax bill might look like for you in retirement, including the effects on Social Security and Medicare, because those can be taxable or means tested as well. And that has to do with this conversation. Pick up the phone, give Chris McIntire a call, 800-868-1194, 800-868-1194, 800-868-1194. So Chris, for those who may have hit limits or limitations, the most common strategy is that backdoor Roth conversion, as it's called, correct?
Absolutely. And so what we mean by that is you could open an IRA account that is non-deductible, which means you don't get to deduct it off your income taxes, and there's no income limits to that. And then you can convert that to a Roth IRA the next day. I actually did that in 2020. So I have done that strategy. put money into a non-deductible IRA account and then converted it to a Roth IRA. So that's kind of the backdoor strategy. And, there are some other ones that are available, Peter. I'm a life insurance guy. Life insurance is incredibly tax friendly, and it's not all about people dying. There are many benefits to life insurance called living benefits. And I use that strategy for myself and many of our other clients where I'll kind of say you overfund a life insurance policy, right? You can put more money than the monthly bill that they give you to put into it, to create cash value inside that policy. And then if you want to create an income stream, you can just simply borrow against your policy. So your cash stays in your policy. The insurance company gives you a loan, charge you a little bit of interest on the loan. The concept is, hey, if I make more money on the investment side than I do the interest rate, God, I'm making money on the money I've borrowed. Call that a positive arbitrage.
Yep, and banks make their money off of arbitrage. They take our money and give us a low interest rate, and then they loan it back out to others, and they charge them a higher interest rate. This is essentially the same concept. And in fact, Chris, I've heard it called bank on yourself or become your own banker kind of concepts there. But it's basically another alternative to building tax-free income for ourselves. So Roth is not the only one. There are a couple other alternatives and options for building a tax-free benefit, tax-free growth, tax-free income, tax-free inheritance.
Correct, Peter. So the Roth IRA, which means that's something that we're doing on our own. The life insurance is kind of as another way of, creating tax-free income. And then, if you have an employer plan and, you're well compensated and you can't contribute to an IRA on your own, up there north of $200,000 for a married couple, you cannot contribute to a Roth IRA. And those change every year. So we're just giving you ballparks here, guys. But if you have a Roth 401k at work, you can put money into that. That's the employer plan loophole.
So even if, Chris, we are not allowed to make those IRA contributions on our own, if our company offers a plan, we may want to explore that because those offer higher limits anyway, right?
Correct. Yeah, you can put up, $25,000 a year in 401k plans. And if you're over the age of 50, they have those catch-up provisions and everything in there as well, too. So, that may be more advantageous to you than the $6,000 or $7,000 you can put into a Roth this year. We'll speak of people over the age of 50. That's typically our audience. So 7,000 for those of you over the age of 50.
So Chris, if maybe my employer offers a plan, it would be worth the time to go and ask if they offer a Roth component, and they might even be able to add that Roth component if they don't currently have it.
Yeah, you're absolutely right. Talk to HR and say, hey, would you call up our plan provider, Fidelity, Vanguard, whoever it may be, and say, hey, can you open up the Roth 401k as well? And, I would certainly think if enough of you did it, they'd be open to doing that. And it's $26,000 for 401ks if you're over the age of 50 here, just to clarify for everybody.
Yep. But significantly more than the amount that we're limited to in an IRA. So again, those employer-sponsored plans might be a great opportunity, especially for those who are higher income earners or who have already maxed out their own individual IRA. You've hit those limits, you've hit those limitations, and you're still looking to save more and supercharge for retirement, ladies and gentlemen. Find out about those options, explore all of them, because the more you can do, obviously, the better the retirement picture is going to look. And Chris McIntire can help you identify those opportunities. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194. So Chris, if we have not hit those limits or limitations, you've got a handful of different specific strategies for making contributions and maximizing our contributions to these tax-free accounts and Roths.
Certainly, if you're a married couple out there, your husband can put in over the age of 50, $7,000. And then if the wife is over the age of 50, $7,000 for her. So you can do $14,000 even if one's not working. So they call that a spousal IRA or spousal Roth IRA. So that's one of the methods that you have the ability to utilize there. Again, the non-deductible IRA is also the potential that's out there. But we always encourage people, if the spouse is retired, a lot of people think that, well, now that my spouse is retired, we can't put anything more into IRA savings for them or Roth IRA savings, and that's not necessarily the case.
Not the case. The ability to double up if we are married. You hear, hey, your limit is 7,000. Well, not quite. The household limit for a married couple might be as high as 14,000. And Chris, there's a magic time of year between January 1st and tax filing day where we can even double up because we can do last year and this year.
Correct. Yeah. With IRAs and Roth IRAs, you have until April 15th or the tax filing deadline. With 401ks, you have to do that within that calendar year. And, for a lot of folks, the 401k sometimes is the easiest method because that money's coming out of your paycheck on a weekly basis. That's how people pay their income taxes for the most part. And so, some of that might be an easier thing for you to do from a budget or even a disciplinarian side of things here. I get that. That's quite all right. Nothing wrong with that.
Yep. Well, Chris, another strategy is to use your return. Maybe if we're getting a return back, that would be some cash that's available to further our retirement progress.
Absolutely. Many of you do get a tax return back at the end of the year because you've overpaid your taxes, and you can use that money to deposit into your IRA or your Roth IRA. Some folks are listening to the show might be over the age of 72, so they have required minimum distributions. You could take that money and, if your spouse isn't old enough yet, you can donate that to your spouse, and that probably works with both sexes here. Donate it either way and use that money to contribute into retirement plans as well. Not everybody needs their required minimum distribution at 72 to live on. Some people, it's just discretionary income. So can you redirect that? You cannot convert your required minimum distribution into a Roth, guys. Remember that. You cannot convert your required minimum distribution into your own Roth IRA.
So I'm going to jump ahead here a little bit, Chris. What you're saying here is that if one spouse is taking an RMD and another spouse is still working, take that RMD and make a contribution for the spouse that is still working with that RMD. But another one that is on your list of conversion strategies is using your RMD. And I want to clarify here again what you just said. You cannot convert an RMD, but you can take the RMD, pay the tax, and with the net proceeds, maybe use that to convert additional dollars from your traditional IRA to the Roth IRA. And it's a strategy that I know you're looking at for certain individuals that meet specific criteria there.
Correct, Peter. And this is that popular time. So that's why we talk about Roth IRAs here at the end of the year, because most of you, have earned most of your income, and there's no real surprises between now and December 31st. So this would be
right.
The time of year where you would want to take advantage of that. And
by the way, RMDs waived for 2020. Another important caveat here, I guess, on these strategies.
Yeah, that's a good point there, Peter. And, that's been something we've been dealing with all year is contacting clients and, do you still want to take your required minimum distribution or not, that they've waived it. And, but the other side, or another opportunity, I'm sorry, Peter, is, the stock market doesn't always deliver us robust returns. So like in the month of March of 2020 here, the market went down. That would have been a good time for people to say, you know what, I'm not selling anything. I'm just going to ride this thing out. But, I just lost 25 or 30% in the market. I'm going to move that money over into my Roth IRA, and then it will recover. And, we'll hit bumps in the road here, obviously, as we work our way through this global pandemic. There'll be other opportunities. So remember, guys, there are always opportunities out there, guys and gals. When the market goes down, think tax strategies and, repositioning strategies for, riding the recovery wave. Don't just sit there, like a deer with a deer in the headlights, so to speak.
Not hopeful for downturns. We always hate to see downturns in the market, Chris, but as a planner, looking at those for the opportunity that they present to maybe do some strategic tax planning and pay tax on a lesser amount and let growth and recovery happen on a tax-free account rather than a tax-deferred account.
Yeah, you're absolutely right, Peter. And, there's always opportunities out there. No matter what's going on, you have to have your eyes open to be able to and be open to looking at those opportunities.
How about, Chris, if I do have a workplace plan, they offer a match. So obviously I want to take advantage of that, but I am actually contributing over the match amount. Would you recommend that individual maybe speaks with their financial or tax professional to see if that's the best thing for them to be doing?
That's correct, Peter. And, some of the downsides of company plans are a limited investment selection. And so if you're, getting a 3 to a 6% match, do you contribute more than that 3 to 6% of your wages in there? Certainly, take it from somebody that's self-employed. You want to get the free money, of course. But there are, out in the IRA world, away from the 401k or 403b, to be fair here, those company-sponsored plans. In the IRA world, there's a much wider investment options available out there. Almost, I won't say the sky's the limit, because there's a few things you can't contribute into with an IRA, but you can pick individual stocks if you wanted to. You could, put money with different companies. You could go to the bank side. You can go to the insurance company side, and just a broader array of investment options for you on an IRA than you'll have in a typical company 401k plan.
Right, where they've got their sort of set menu that they've decided and determined for you, and you just get to pick and choose between those, but make the lines add up to 100%, which is often the only guidance we get, which is why it's important to listen to insight and advice like what you provide, Chris, where maybe we have a little bit more opportunity to be strategic and control our financial outcome. And one of those decisions is, do we contribute more to that plan, or do we go outside and create our own retirement savings accounts and opportunities in IRAs? And specifically here, we're talking about these Roth IRAs. And ladies and gentlemen, again, if you want to figure out that ideal order of operations and how you should be saving for retirement, or on the other side of retirement, how you should be accessing those accounts and drawing from them, that can make a difference as well, a big impact on the longevity, sustainability of your money, of your income. Pick up the phone, give Chris McIntire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. But again, Chris, if we do have the opportunity for the Roth at work, that does offer significantly higher amounts that we can save for retirement tax-free within a given calendar year.
Absolutely. And folks, income tax rates are very low right now. So we would say that take advantage of tax rates being low. We don't know where they're going to go into the future here, as the impact of the election shakes out and legislative changes come and go. I think most of us would probably make the argument that there's a higher probability of income taxes going up, over the next decade, because of all the deficit spending that's been done, regardless of political party persuasion. We're trying to get away from that, folks. So we've had enough of that over the past few years. But again, deficit spending, we've got issues with Medicare, and its funding, and all those, all those entitlement programs. That money gets generated from tax revenue. So, pay attention there, guys. There's a couple of those retirement tax loopholes or potholes, we'll call it, that you can fall into with regard to Social Security being taxed, Medicare premiums potentially being higher, and means testing and things like that. That's we could certainly be looking at down the road here.
Well, again, if you'd like to identify where any of those potholes may be into your financial future so that you can avoid them or plan strategically to minimize the impact, pick up the phone, give Chris McIntire a call, 800-868-1194, 800-868-1194. Chris, you've got another strategy here for doubling up. So we've talked about two so far. You can double up for married couples. Each spouse can make a contribution. You can double up for the calendar years between January 1st and the tax filing deadline. We can make contributions for last year and this year. And then another opportunity to double up on our retirement savings efforts is that we can make both personal contributions in an IRA and participate in workplace plans. So just because we've got a 401k and we're doing that doesn't mean that we automatically can't do an IRA. There are certain limits and limitations, but it is possible to double up there as well.
Sure. Yep. You could put your money into your 401k plan. And then if you've got extra income coming in, you can certainly look at the potential to put money into an IRA or a Roth IRA of your own, and then also one for your spouse too. So there is more opportunities now to save money for retirement than ever before. HSA accounts are also an important piece here. We'll talk about health savings accounts down the road. Today's show was more about the Roth IRA side of things. So remember, contributions, folks, like we said, come from earned income. Conversions means you're adjusting your strategies. I've got money in my 401k. I'm going to convert some of that to a Roth 401k or a Roth IRA. I've got a traditional IRA. I'm going to convert some of that into my Roth IRA. And again, guys, these aren't things you just do, at the drop of a hat. You want to make sure you've talked with a professional to understand the tax ramifications of these. Are you eligible to do these as well? If you're not 59 and a half, you might not be able to take money from your 401k and put it into a Roth IRA. You have to have a triggering event in there, and 59 and a half is one of those.
Yep, but Roth IRAs, while there is that tag that it is intended for retirement, they're actually a little bit more flexible and accessible than, say, 401k or traditional IRA money, because you've already paid tax on it. The government doesn't mind you pulling it back out and getting it back into the taxable circulation again, right, Chris?
That's for sure, buddy. They'll be happy to take whatever you want to donate to the cause there. And again, tax planning is just simply being aware of where what the tax status is on all your dollars, how that impacts your Social Security, your Medicare eligibility for the standard premiums in there, but also looking forward, looking down the road. Is this money that's you're going to, leave to kids for inheritance and you're not going to spend? Then, is investments the place it should be, or do you leverage some life insurance? Or do you convert to Roth IRAs? A number of different opportunities out there, and you have to have an open mind. That's part of our job as, being fiduciaries is, look, what are all the opportunities out there? There are certain things we favor that we don't favor, but, you have to be able to explain these to the individual clients one-on-one, because, what we like, they may not like. And, you got to pull your personal opinions out of here, lay out the, deal the cards and say, okay, if you play this hand, this is what happens. If you play this hand, this is what happens.
Well, Chris, just doing a little bit of quick math here on the available strategies to double up those contributions. For a married couple, we can get $14,000 in a given year if we're over the age of 50. If we do it strategically between the tax deadline, we could get 2 years worth of contributions. That's $28,000 now. And if we are also offered a workplace plan and each of us participate there, that's another $26,000 a piece, $52,000 plus the 28. We could theoretically get $80,000 in a single year put away into various tax-free accounts. And let's say that we just got a windfall, or we're in the years where we're really getting ready for retirement. We've kept our expenses low, our income is high, maybe the kids are out and the house is paid off, so we've got some available discretionary income. We could really make some significant headway toward contributing and getting ready for that ideal retirement that we envision.
You're right, Peter. And, you've made a good analogy here before that, time is our most valuable asset, and money cannot buy time. So the younger that you are out there, the more time you have to get these things in place. I have clients that are, older, 75, and they're talking, hey, should we be converting into Roth IRAs now? And it doesn't make sense for them. Okay. I have younger folks that earn a good fair amount of income right now, and Roth IRAs may not make sense for them right now. Okay. But some folks, certainly it makes sense to look at the opportunities to have compounded dollars, dividends and interest that are compounding income tax free. If you pass away, you're passing away money that is income tax free. Just, marvelous opportunities out there like we've never had before. And it's time to change the paradigm, the way of thinking. What we used to do doesn't mean it's what we need to do going forward, now that with all the legislative changes in the low income tax brackets that we have now compared to the early 1980s.
Well, I will agree and reiterate, again, Chris, the money can't buy time, or it's been said can't buy happiness. But I think that not having to deal with taxes probably gives us a little bit of happiness. And if we've already prepaid our taxes during our working career, we can actually make our money last longer in retirement because we get to keep more of it. So that's essentially buying a little bit more time. We might be a little bit more content in retirement if we've got tax-free money working for us and building to support us into retirement, tax-free growth, tax-free income, tax-free inheritance. And that's what these opportunities with the Roth IRA, Roth 401k, or even certain life insurance strategies are really all about. And if you'd like to learn more, ladies and gentlemen, pick up the phone, give Chris McIntire a call, 800-868-1194, 800-868-1194, 800-868-1194. Finally, Chris, to wrap this up, I know that you can run reports and show people what their tax bill might look like for the foreseeable future if they sort of default to the government's plan versus what it would be if they did consider enacting some of these Roth conversion strategies. And sometimes the difference can be rather significant.
It certainly can, Peter. And here's an example. Imagine, you've worked hard all your life and you see this car that you've always wanted, or the condominium in Fort Myers that you've always wanted, and it's going to cost you $100,000, and you can say, well, I don't want to pull that out of my IRA because it's going to cost me $125,000 by the time I paid the tax. If you had that money sitting in a Roth IRA, are you more bound to do something you've always wanted to and desired to do?
Again, you've got opportunities, ladies and gentlemen, available to us today. And we know what tax rates are today. We may want to take advantage of where they are and realize that tax bill, minimize it into the future. Pick up the phone, give a call to Chris McIntire. He can help you plan these things out strategically to be efficient with your money and keep as much of it as possible. 800-868-1194. That's 800-868-1194. Chris, it is always a pleasure. Thank you for being our resource here on Game Plan for Retirement.
It's my pleasure, folks. Everybody stay safe out there and go visit the Outer Banks there if you get a chance.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.